I've been trading for around 14 years, and in this video I'm going to show you one of the best strategies that I have found over all those years of trading, and I'll show you exactly how to find the right entry, where to get into a trade, where to put stops, targets, how to do a proper multi-time frame analysis, and provide a lot of tips on how to do multi-time frame trend following trading the right way. So where do we find the best entry when we look at trending markets and when we want to trade a trend? So whether we look at Elliott wave theory, Dow theory, or any other market theory, we understand that the market moves in those waves of ups and downs, and this is generally how a trend unfolds. So where is the best entry here? First of all, many traders make the mistake that they are too early in a trend where you don't have enough information. So generally we're trading wave 1 until wave 3. Not super recommended because we don't have too much information. We don't know that the market is making higher lows and higher highs yet. So that's a little bit too early and too aggressive. Don't also trade a late trend. So this is way too late in a trend, somewhere around wave 7, 8. Generally not recommended because the major part of a trend has already happened. Mature trends, wave 5 until wave 7, a little bit better. Although the market has already moved quite a bit, you are generally not trading after wave 7. That is not recommended. So still, maybe a little bit of profit potential is left. But where you really find the best opportunities is early on in a trend, not too early, and also not too late. So somewhere right in the middle when the market is confirming its first higher high and higher low structure. This is where you're going to find amazing trades with the best reward to risk ratio, have a lot of confluence, and you're early on in a trend so that we can find optimal trading scenarios. Whenever I look at a chart, I always ask myself, do I want to be long here or do I want to be short? And let's take a look at what we see here. We see that the market has been in a very long uptrend. So a lot of trend waves into the uptrending trend direction. So do I want to be long? Probably not, because first of all, the market has not continued the trend structure. So we are not making a higher high. And also, generally speaking, we are very late in an uptrend. So that would feel way too late for my taste to be long here, since the market has already progressed. Do I want to be short? Probably also not, because we are still looking at a confirmed uptrend. The market has not made any break of the trend structure. We are still making higher highs and higher lows. So we are too late for longs and too early for shorts. But what we're going to do now? First, we're going to define our swing points. We definitely don't want to be long as the market isn't continuing. And we don't want to be short until the market is breaking the trend structure and making a lower low. We kind of maybe making a little bit of a lower high already, but that's not enough yet because we are still here in the middle of this trend wave. So looking at the wave structure as we did in the beginning, where are we now? You can see the market is in wave 1, 2, 3, 4, 5, 6, 7. Wave 7, generally not a good idea to be long, way too late. And when we are looking at a potential downtrend, we are way too early because we have no confirmation. We want to trade here. We want to wait for the market to break into a first lower low and then also confirm the structure. We want to see that a lower low is holding. So previous support has to turn into resistance, and that is where we're looking for a trend. This is where you find the best reward to risk ratio. You still have a lot of confluence, you're not too early, and we have a lot of information that we can use. So let's approach this. First of all, we define our entry point. We want to see the market break below this area. We wait for the breakout to happen. In this case, you can see we have a very nice breakout structure. We can see that the market is staying below the trend structure. We can see that 2 candles later, the market is pulling back into the level, but this is not where we want to go short because the market is just making a very strong bullish move. We definitely don't want to go against such a strong bullish candle. That would be not really recommended because you are trading against momentum. We want to always be with momentum. So how do we do that? We wait for the market to slow down first at the breakout level, and then we go to a lower time frame. This is how it looks on the 5-minute, whereas this is the 1 hour, this is the 5-minute, and you can see this is the breakout sequence, this is the pullback, and you can see we have a very nice wedge or triangle pattern that we're going to use. As soon as the market is breaking out of the wedge, we have information that the market is turning, the higher time frame resistance level is now holding, and the market is moving into our trade direction. So this is where we want to get in. Theoretically, this could have been a short entry. When you look for a stop loss, a good idea would be to place it outside of the trend structure. So we want to put our stop loss somewhere above the previous highs, because if the market breaks this high, it's okay to be out. I don't want to hold a short if the market continues to make higher highs on the lower time frame. So that would be a good idea for a stop loss. You don't want to put your stop right at the high, because volatility can be an issue, and also if you're trading with a variable spread model on your broker, the spread can also be an issue. So give this room a little bit time to breathe, or room to breathe, and then your stop loss is a little bit more protected. For targets, you have a few options. You could either go for the previous low. You could have an open-ended target where you just write the trade, maybe with a trailing stop loss behind the 20 period moving average. But that is there's a lot of options. And if you're interested in maybe having me made a separate video about targets, leave it in the comments below. So this is how it then afterwards looks on the higher time frame. You can see this is where we found the pattern. This is where we found the entry on the lower time frame. And this is how the market then unfolded. And you can really nicely see how the market made its way into the uptrend, lost a little bit momentum, was failing to make a higher high, made a lower low here, retested the previous structure, and then the new downtrend unfolded here very nicely. So let's talk about a few retest candlestick patterns, because there are a few options and very interesting patterns that can help us understand retests better. So when we look at here this downtrending market, you can see we have very late downtrend, 1, 2, 3, 4, 5, 6, 7 trend waves to the downside. The market is breaking into its first higher high, and then it's pulling back into the previous resistance, which is now turning into support. Let's zoom in. And we can see that this is an engulfing pattern. The fact that this is not fully engulfing, they are maybe missing 1 or 2 pips, that's totally fine. I would still count that as an engulfing pattern. And you can see this is a very strong signal. The market moved into the previous resistance, turning into support, and then moved strongly away. At this point, it would be a good idea to go to a lower time frame. I'm pretty sure you would be able to see here a trend line, a triangle, a wedge pattern that would then allow you to trade it. And that is what then happened afterwards. As I said previously, targets, you could look left and look for important support and resistance areas. If you don't like to apply a trailing stop loss approach, that could be an idea. Second retest candle is a pin bar rejection. So the market is again in a downtrend. You can see a very long downtrend. And then once the market breaks the structure, breaks the previous resistance, coming back into it, turning into support. Let's look and see how this looks on the lower time frames. So this is the 1 hour. Here's the pin bar once again on the 1 hour when we zoom in. And this is how it looks on the 15 minute. So you can see beyond the 15 minute, this is how the pin bar looks on the lower time frame. And a higher time frame pin bar very often turns into a lower time frame head and shoulder, or in this case an inverse head and shoulder. We can see the market has a left shoulder, the head, which is retesting the previous resistance as support, and then here is the right shoulder. And the entry signal would have been the break of the neckline when the market continues into the trade direction, into the new trend direction. And this is what happens afterwards. You can see the breakout happened here. The stop loss, again, you have options. You could put it right at the right shoulder, below the head, or right at the breakout level. The stop loss, as always, as I keep saying, depends a little bit on your level of aggressiveness. The closer your stop loss, the higher reward to risk ratio, but obviously you will also be taken out much more frequently when the market spikes against you. So usually I would recommend stops somewhere in the middle, so you're not too aggressive, but also not giving away too much reward to risk ratio. Again, targets, very straightforward. Just look left, look for important support levels that are turning into resistance. You could also use them to scale out of your trades. So once you have identified this as a previous resistance area, you could first of all scale out and then hold your trade and see what happens. Is the market struggling? Like in this case, maybe a good idea to take it out after you see that the market is failing to make a higher high. And if the market does continue to move higher, you could then look for the next resistance level and then take full exit. Important, if you decide to become a retest trader, sometimes there just won't be a retest. Sometimes the market will just break out of a structure and never look back, and that's totally fine. You have to understand that if you're a retest trader, the retest is your edge. The breakout is not your edge. And if the market is not giving you a pattern that is giving you a retest entry, then so be it. Don't chase it. Don't try to somehow get into it late. You will regret it, I'm pretty sure, later on. So if you don't have a retest, Just wait for the next trade. There's always going to be a next trade. And that is very important as a retest trader.